Hello and welcome to the Investment Conversation. Today we're going to be covering China's impact on the global economy, how the country impacts those economies around it, and finally, the investment implications for our audience.
Welcome to the Investment Conversation.
Hi, my name is John George. Today we're talking about China with my guest, Giulio Martini, Lord Abbett's Director of Strategic Asset Allocation. Welcome, Giulio.
Great to be here, John.
Let's get right into it. How does China as a country fit into the conversation around the global economy?
I think people know that China is a very large country. It's 1.3 billion people, roughly. And I think they know that it's been growing rapidly for a very long period of time, roughly 40 years. What that's done is taken China to the point where it's really the major driver, the biggest driver of growth in the global economy. From 2014 to 2018, 50% of the growth in global GDP in dollar terms came from China. That's an enormous, enormous proportion for a single country to drive. And what that means is that growth in China spills over directly into the rest of the world. If growth is decelerating, it's going to be felt all across the globe in diminished demand for imports. And if growth is accelerating, it's going to have the opposite effect and radiate out very quickly into the rest of the world in a very noticeable way.
And you cited some data points with China. How much can we trust that data that's coming out of China?
Yeah, I think when it comes to data, what people have to remember about China are two things. One is that for most of its modern history, it's been a very poor country. So its data architecture is just very sparse. The second thing is that it's an authoritarian system. And so in many cases, the incentives that people have to report data are influenced by what they think the government wants to hear. So people are rightly skeptical about data from China. When they see GDP, what they see is the fact that much of the data that in the United States would be reported through sample surveys, through actual sound data collection and used to estimate consumer spending or investment spending, in China just doesn't exist. And so it's estimated from very irregular surveys. And in the interval between those surveys, it just is smoothed. Now, that's a reasonable practice, but it results in economic growth numbers that look excessively smooth compared to what they do in other countries. What we do have, the good thing about China, is that that's not the only data available. We do have some data on hard commodity production, whether it's steel, in transportation, we have auto production numbers, and more importantly, we can see, because of China's big impact on other countries, what China's exports to Korea are doing, or what China's imports from Korea or from Taiwan or from Vietnam are doing. And if those imports are growing, we can see the effect by observing what's going on in those other countries. If they're falling, we can see the verification from overseas. So even though the Chinese data directly may not be as informative as we'd like them to be, we can still see the impact that China has on other countries to infer what's going on in China itself.
We talked about how China does impact the economies around it and those that it has trading relationships with. Would you mind just giving us some background on how that all fits into their strategic importance?
Well, China's really a dominant influence on economic growth in a country like Korea. South Korea is a very open economy, meaning it's highly influenced by trade. 80% of Korea's economy is made up of imports and exports. So what goes on in the rest of the world has a big effect on Korea. But because Korea is really part of a supply chain that runs through China, supplies the world with much of its tech and telecom equipment, the share that goes to China is disproportionate. So over 50% of Korea's trade is with China itself, which means you have a very, very direct impact running from China to Korea. And it's very similar for Taiwan, for Vietnam, for, of course, Hong Kong and other places in the region. But in Northeast Asia, China is really the dominant driver of economic growth and of the business cycle. In the rest of the world, it's somewhat less influential. But when you look back in recent past, the times when China has really gone from relatively modest growth to faster growth have radiated out immediately, especially into Europe, but also into South America and into commodity producers as a whole.
What are some of the investment implications that this current dispute, as well as China's growth prospects over the next few years, will have on investment portfolios?
Well, I think the very interesting thing and the analogy I would draw is to late 2015, early 2016. China was in a weak growth period and then took steps to stimulate its economy through directing credit to the housing sector, to other industrial sectors, and growth started to pick up. And what happened in early 2016 is that global trade started to pick up as China recovered, and that produced a stronger economic recovery in Europe. It created a stronger economic recovery in the United States, in the emerging world as a whole. And as companies did better and earnings revisions turned positive, equity markets did extremely well. So right now, we've gone through a period where China's had some weakness related to cutting down on credit growth and trying to reduce financial risk in the system. But it's recognized that that went a little too far over the summer and started to implement a series of stimulus measures, which now seem to be coming through and producing better economic growth. And if that's true, then we should very shortly start to see again a recovery in global trade with benefits primarily from Europe, for Europe right now, because Europe is so weak, but also for emerging economies as a whole. The other thing, though, John, that I want to point out is that the way investors have benefited from China, somewhat paradoxically, has not been by investing in China or in Chinese companies directly, but by investing in other parts of the world that are very strongly affected by what's going on in China itself. So, for instance, global mining companies, particularly Australian ones, have grown enormously and grown their profits enormously because of the increase in commodity demand from China. Global shipping companies have benefited enormously as China's role in global trade has grown. So there's a whole range of things. Even property companies right here in Jersey City have benefited from building by Chinese investors. And so tracking down the footprints of China's influence in other countries has actually been a much more profitable way of taking advantage of what's going on in China than investing directly in China itself. And I think that's, something to really keep in mind as we think about how to respond to what will continue to be a growing influence of China in the global economy.
All right, Giulio, we have a lot to talk about, a lot to think about. Thank you for your insights.
My pleasure, John.
Thank you for joining the investment conversation. Please drop us a line on social media or visit our website at lordabbett.com. Thank you, and see you next time.
That's it for this edition of the Investment Conversation. As always, you can access a full range of investment commentary and analysis at lordabbett.com.